Hello again. We're getting ready to get started here in chapter 12 on the statement of cash flows. So in this chapter we'll get into the details of the statement of cash flows that we've been touching on parts of in several of the previous chapters. And on slide 3, here are the chapter objectives. It's important for you to understand the difference between operating, investing, and financing activities, because that is how the statement is structured, and it's important to know the differences in these types of activities. There are two methods of doing the statement of cash flows, and we will look at each, although we'll spend a lot more time on the indirect method because it's by far the more common of the two and the easier one to do. Finally, we'll discuss how this statement can be used to evaluate a company's performance. And on slide 4, here's the organization chart presentation of the chapter objectives. Notice again that there are two methods of preparing the statement of cash flows, the direct and indirect, and we'll cover each of them, but again, we'll spend most of our time on the indirect. On slide 5, here are some of the main reasons the statement of cash flows is useful in analyzing where the company is regarding its sources and uses of cash, and where it may be headed in its ability to generate cash in the future. On slide 6, this slide shows a description of what constitutes the operating, investing, and financing activities in a statement of cash flows. These are important concepts for quiz and exam purposes. Operating activities, as the name implies, covers day-to-day operations that generate revenues or inflows of cash, and expenses or outflows of cash. Investing activities cover investments that the company makes, including long-term assets such as property, plant, and equipment. And financing activities have to do with long-term liabilities or stockholders' equity related transactions, such as bond financing or stock issuances. And on slide 7, here's some detail on the cash flows from operating activities that would typically have impact on this section of the statement of cash flows. Look at the various inflow and outflow items and make sure you understand them and why they belong in this section, that is, day-to-day operations. So, typical things that happen in the business, cash payments to suppliers for inventory, to employees for services, to government for taxes, to lenders for interest, and to others for various expenses. And the inflows, obviously, from the sale of goods or services, and from interest received and dividends received, if any. And on slide 8, now here are some of the details for the same details for the investing and the financing activity sections of the statement of cash flows. Note again the common items to these sections, both from an inflow and an outflow perspective. Clearly, if outflows exceed inflows for the period, that section of the statement of cash flows will be a negative balance that will need to be subtracted from, or not added to, the beginning cash balance for the period. Note that in the investing activities section, loans to other entities are included. However, loans the entity itself takes, via bond issues, for example, are shown under the financing activities section. Remember this distinction. Finally, notice in the financing activities section that acquisition of treasury stock is a potential outflow item, along with cash dividends and redemption or repayment, that is, of long-term debt. Remember that interest payments are covered in the operating activities section. Moving to slide 9, obviously cash activities alone don't tell the whole story of what the company is doing in its financial activities. Significant non-cash activities must be reported also, either in a separate schedule provided with the statement of cash flows, or as a separate note to the financial statements as noted on the slide. 4 common examples of such activities are shown here, and we'll be dealing with some of these examples as we go along. On slide 10, there are some significant differences here, and as explained on page 680, this has mostly to do with the accrual basis of accounting and matching revenues and expenses of the period, regardless of when cash was actually received or paid. There's also the impact of non-cash expenses, such as depreciation and amortization, on net income. On slide 11, under both methods of performing the statement of cash flows, the order of presentation is the same: operating followed by investing and then financing activities. As we will see in a couple of slides, the indirect method is far and away the more common method used, but we will spend some time at the end on the direct method as well. And on slide 12, it's important to understand the flow of the statement of cash flows in order to make sure you add or subtract the correct amounts to get a net increase or decrease in cash for the period, which is then added to or subtracted from the beginning cash balance to get the ending cash balance. By the way, the ending balance of cash as computed in the statement of cash flows should be compared to the cash balance in the balance sheet to ensure that they agree. If they don't, then there is a problem that needs to be looked into before the financial statements can be finalized. On slide 13, which is also shown on page 627 of the text, here are 5 typical transactions that all involve the receipt or payment of cash, and therefore would need to be included in the statement of cash flows. The question is, which section does each one belong? Number 1, issuing shares of common stock, is a financing activity since it is done to help finance current or future operations or capital projects. Number 2, borrowing via the use of a long-term note payable, is also a financing activity done for similar reasons as for the stock issuance. Number 3, the purchase of major equipment for the business is an investing activity since the equipment is purchased to help produce revenues for the company. Number 4, paying salaries and wages is a routine and repetitive activity that is part of day-to-day operations, so it should be classified as an operating activity. And finally, number 5, collecting cash for services rendered is also a routine and repetitive activity that belongs under operating activities on the statement of cash flows. And on slide 14, at a company's onset of operations, there's normally a lot of financing activity as the company raises capital to start and begin operating the business. As a company ramps up production and grows, the operating and investing activities also grow, and financing activity may level out or even decrease. So that's really all this chart is trying to tell us. On slide 15, in viewing this vignette on net income and cash provided or used by operations, investing and financing for several companies, and keeping in mind the previous chart on the cycles of business, the one that stands out, at least to me, is LDK Solar, with both a net loss and a negative cash flow from operations, but a hefty cash provided by financing, which you would expect for a company in its early stages. On slide 16, here are the key ingredients needed to prepare the statement of cash flows using the indirect method in particular. We'll see what the additional information is a little bit later, although we've alluded to it already. On slide 17, the first step is to convert net income from that computed on an accrual basis, as it should be under GAAP, to basically a cash basis. This involves both the income statement and the comparative, that is current and previous year, balance sheets, and as the slide notes, selected additional data. On slide 18, step 2 involves analyzing the changes in non-current assets and liabilities to record these as investing or financing activities or disclose them as non-cash transactions. Remember that step 1 was looking only at the current assets and liabilities changes in the balance sheet. And step 3, as we go to slide 19, is to compare the net change in cash on the statement of cash flows with the change in cash reported on the comparative balance sheet for current and previous years, remembering that the ending balance of year 1 is the beginning balance for year 2. These amounts should agree. Again, if they don't, we've got a problem that needs to be looked into. Now on slide 20, preparing the statement of cash flows in the way just described, that is the indirect method, is easier and less costly than the direct method, and that's one reason why most companies use the indirect method. Also, the indirect method focuses on the differences between net income and net cash flow from operating activities, which the direct method does not. And on slide 21, so here we begin an illustration that starts on page 631 of the text. The net income of $145,000 is the key figure here to start with. On slide 22, next we look at the comparative balance sheets, although the book shows these first. It's important to know which way these increases and decreases to current asset and liability accounts affect the cash flows from operations. As an example, let's look at the $10,000 decrease in accounts receivable. Since receivables decreased during the year, it's safe to assume that cash collections outpaced credit sales by about the same amount, that is $10,000. Therefore, the decrease in a current asset is a plus regarding the cash flow from operating activities, which may seem counterintuitive at first, but when you think about the way that net income is computed on the accrual basis, it has not considered the fact that collections did outpace credit sales by this $10,000, and that's why it needs to be added back in the statement of cash flows. We'll come back to the PP&E increases and decreases in a moment. On slide 23, now let's look at what an increase in a current liability account, such as accounts payable, does to the cash flows from operating activities. Since the liability increased, this means it's safe to assume that credit purchases outpaced cash payments, meaning that this had a plus impact on the cash flows from operating activities vis-a-vis, again, net income. Remembering that net income on the accrual basis captured all expenses, including those on credit. And that's why it would not have considered the fact that credit purchases actually outpaced cash payments. So again, an increase in a current liability account would need to be added back in the statement of cash flows to net income, even though this seems on the face of it to be counterintuitive. Now let's look at the additional information for a moment. Knowing how much depreciation expense went toward building versus equipment may impact on the cash flows from investing activities, but actually I don't think it will. I'm not really sure why they broke that out for us, except for the purposes of journal entries. Item 2 involves a cash inflow of $4,000, although the equipment was sold at a loss, that is below its book value. Item number 3 did not involve any cash, exchange of bonds payable for land, but it is a significant non-cash transaction that should be disclosed. Item number 4 involves 2 investing activities, each with an outflow of cash. Item number 5 is a financing activity, common stock issued for cash. And item 6 is also a financing activity, a cash outflow for payment of dividends to shareholders. And with that, we will wrap up this part of the presentation.